We'll be going over the Simplified Method Worksheet for lines 5A and 5B of your Form 1040. So this is the simplified method for calculating the tax-free part of annuity payments. And if you have an annuity and you meet certain conditions, you have to use the simplified method to determine the tax-free amount of your annuity payment. And those conditions are if you receive your pension from or annuity payments from a qualified employee plan, a qualified employee annuity, or a tax sheltered annuity plan such as a 403b. And then if you on your annuity start date, one of the following conditions applies. Either you are under the age of 75 or you are entitled to less than 5 years of guaranteed payments. And if your annuity start date is after November 18th, 1986. So if those situations are true, then you do need to use the simplified method worksheet to calculate your tax-free part of your annuity payments. However, if you are the beneficiary, there are a couple of things. One, if you are the beneficiary of a deceased employee or a former employee who died before August 21st, 1996, then you would include any death benefit exclusion that you're entitled to in line 2. You would up to $5,000. If you had more than one partially taxable pension or annuity, then you would figure the taxable part of each one separately. And then you would enter the total of all taxable parts on Form 1040 or 1040 SR, line 5B. You would enter the total pension or annuity payments received in the tax year on line 5A of your Form 1040. So this simplified method worksheet, we're actually using a different hero in this video. Normally our hero is John Doe. However, we're taking this story and the numbers straight from the worksheet instructions located in publication 575. So the example is Bill Smith. He's age 65 and he began receiving retirement benefits under a joint and survivor annuity. His starting date is January 1st of this year, and the benefits are to be paid for the joint lives of Bill and his spouse, who is also age 65. Bill had contributed $31,000 to a qualified plan and did not receive any distributions before the annuity start date. He is expected to receive a monthly retirement benefit of $1,200, and then his spouse will receive a survivor benefit of $600 upon Bill's death. Bill must use the simplified method to figure his taxable annuity because his payments are from a qualified plan and he is under the age of 75. But because his annuity is payable over the lives of more than one annuitant, he'll use his and his spouse's combined ages and table 2 at the bottom of this to calculate line 3. So again, table 1 is for a single life. And then if there are 2, like a joint and survivor annuity, then you would enter the number for the combined ages. And we'll get to that momentarily. Bill's tax-free monthly amount is $100 based on, as shown on line 4 of the worksheet. Upon Bill's death, if he hasn't recovered the full $31,000 investment, then his spouse will also include $100 from her $600 monthly payments. The full amount of any annuity payments received after 310 payments are paid must be included in gross income. And then if they both die before 310 payments are made, then an itemized deduction will be allowed for the unrecovered cost on the final tax return of the last person to pass away. So basically, we're going to walk through, we'll point out how we get to that $100 per month number, and then we'll move forward. So in line 1, we're going to enter the total pension or annuity payments from the Form 1099-R. As mentioned, this was reported to be $1,200 a month or $14,400 for the entire year. In line 2, we'll enter the cost in the plan at the annuity start date. So as we mentioned, that was $31,000. We're going to enter the appropriate number from table 2. So if this were just a single annuitant, then we would be going to table 1. But because the start date is after 1997 and the payments are for a joint and spouse or joint and survivor, we're going to go, and they were both age 65, so their combined ages would be 130. That goes over to 310. So that means that the $31,000 will be, that's the tax-free portion of his annuity payment, the $31,000, because that's the cost of his investment. So we're going to divide the 310 into the $31,000. Basically, 310 payments results in $100 per month. So $100 per month for 310 months. At the end of that 310th month, he has recaptured his entire cost in the plan, and every annuity payment after that is completely taxable. So right now, this $1,200, the $100, we multiply that by the number of payments that were made in the year, which was 12. So we have $1,200. Now, this annuity was not started before 1987, but if it were, then you would enter this amount on line 8. We're going to go to line 6 to see if there were any recovered tax, if there are any amounts that were recovered tax-free after 1986. Okay, so since this is the first year of the annuity, there's nothing to go back to last year's worksheet to do. So the line 10 amount would be, if we're filling this out for next year, the line 10 amount would come down here, and then we would subtract the $1,200 that had been paid out from the $31,000 so that we keep a running track of how much of this investment we still have left to recoup. But this is the first year of that, so we don't have anything from last year. We're starting with the $31,000. So now we're going to enter the smaller of the $1,200 of payments or the remaining amount of the annuity, which is the full $31,000. So of course the smaller amount is $1,200. Now we're going to subtract this from the full amount of payments, the $14,400. And this means that the $13,200 is taxable income. This will be the amount that you enter on line 5B of your Form 1040 or your 1040 SR. So if your Form 1099-R shows a larger amount, you can use this amount instead of the amount from the Form 1099-R. If you are a retired public safety officer, then you should see specific guidance on insurance premiums for retired public safety officers before you enter any amount on your Form 1040. So the last question, question 10, is, was your annuity start date before 1987? It is not, so we're going to add lines 6 and 8. This would be the amount that we still have left to recover. So basically, we didn't have anything from last year. We took out the $1,200 this year. So now we need to subtract this $1,200 from line 2. And we have $29,800. That is the amount that will be recovered next year. So if this amount were 0, then you would not have to complete this worksheet next year. You would simply just pay the full amount of tax from here on out. So there's kind of a decent amount of information here, but you can look at the You can look at the step-by-step guidance in IRS publication 575. You can also take a look at this form instruction. It's in the instructions for IRS Form 1040. You can read a little bit about the background information, particularly as it pertains to public safety officers. We did mention a couple of forms in this video, so we'll go ahead and put links in the show notes to the articles and videos that we've created on that. If you like our articles, feel free to subscribe to our newsletter. And if you like our YouTube videos, please subscribe to our YouTube channel. And if you have any questions, comments, or if there's a topic that you would like to see discussed in an upcoming video, please hit me up in the comments section. Thank you very much and have a great day.